Schroder has had a good year. The European Real Estate Investment Trust has reported a 31% rise in earnings from operational activities for the full year. That's thanks to rental growth and income from the recently acquired Alkmaar asset, underpinned by a low-cost fixed-rate debt position. Looking ahead, the firm's chair Julian Burney says the group's attractive portfolio income characteristics, its exposure to high-growth sectors and its pipeline of asset management activity should contribute to further earnings growth, and this will enable Schroder to progress its dividend over time. British American Tobacco says it will take a hit of around $31.5 billion as it writes down the value of some U.S. cigarette brands. That's as the firm has acknowledged that its traditional market has no long-term future. The move comes as stricter regulation and growing awareness of health risks squeeze tobacco companies' traditional business. In response to this, the maker of Lucky Strike and Daniel's new ambition is to now generate 50% of its revenues from non-combustibles by 2025. And it expects a business from so-called new categories to break even this year, which is a year ahead of previous projections. Along with this detail, BAT also gave a trading update. The cigarette maker expects full-year revenue growth to be at the lower end of its 3 to 5% range, and it has forecast a low single-digit rise in revenue and adjusted profit from operations for 2024. Tharisa has felt the pinch of lower platinum group metal prices, and this will weigh on earnings. The miner says headline earnings per share for the full year are likely to be around 28 US cents. This reflects a reduction of as much as 33% when compared to the previous period. Full detail will be available when the company opens its books on the 14th of December. Met Air CEO Stuart Devenga has announced his resignation due to health reasons. He will leave the automotive components manufacturer and battery maker at the end of January. That's after being in the position for less than a year. Several Met Air board members have left over the past year, but the company has stated that its leadership team is stable, experienced and skilled as it starts the search for Devenga's successor. AO Technologies plunged deeper into the red despite a 28% rise in revenue. The group's headline loss per share more than doubled to 176 cents, or more than doubled 176 cents. AO has pointed to declining gross margins, lower fair value adjustments on investments, along with loan impairments. Further afield, a Volkswagen-commissioned audit of its jointly owned site in Xinjiang, China, has found no signs of forced labor, although the auditor added that the challenges of data collection in China are widely known. Here's more insight in the following report.
Volkswagen shareholders demanded the auto giant show more transparency on Wednesday. The comments came from Union Investment and Decker Investment, two key stakeholders in the company. It reflects ongoing concerns over Volkswagen's engagement in China's Xinjiang region. Rights groups have documented abuses, including forced labour in detention camps. Beijing denies all such charges. On Tuesday, Volkswagen said a long-awaited independent audit had found no evidence of forced labour at its jointly owned site in Xinjiang. Although the auditor further said the challenges of data collection in China were widely known. The investigation included on-site interviews and inspection of employee contracts and salary payments for the site's 197 employees. Union Investment called the audit a step in the right direction, but warned VW had not yet reached its goal. They argued there is still a lot to do and that a functioning complaints management system must be established. Even so, investors liked what they heard about the audit.
And leaders from Germany and Brazil are calling for the finalization of the EU-Mercosur trade pact. Let's check in with our reporter Dowling Luchela for an update on where things are. Dowling.
Well, Zinati, for years, the EU and South America's common market, Mercosur, have been negotiating a free trade agreement, but hopes a deal could be signed this week have been shattered. And joining us now with more is DW correspondent Chiponda Chimbelu. Thanks for your time today. Now, Chiponda, what's the hold up here? Why aren't the two states finalizing the deal this week?
Thanks for having me. One of the reasons this deal won't be signed this week is that Argentina's outgoing government is against it. Buenos Aires said that the deal would have a negative impact on its manufacturing and agricultural exports. Now, that is something that goes against the wishes of its neighboring country, Brazil, which would have liked to see the deal signed this week. In fact, President Lula da Silva of Brazil was in Berlin and he met with German Chancellor Olaf Scholz on Monday. There had been hopes then that there could be a breakthrough, but that didn't happen. And we also need to consider, of course, that it's not just Argentina holding up the deal. France here in Europe has been against it as well, calling for more additional environmental commitments from Mercosur states before the deal is signed. In fact, French President Macron reportedly said that the deal is outdated, incoherent, and good for no one. So that's also not the only criticism we've heard here in Europe. There's also concern over the influx of cheap goods in some countries. So there's a lot going on there in terms of criticism.
And how will the delay affect any potential trade agreement?
Well, this deal between the EU and the Mercosur states, so that would be Brazil, Argentina, Uruguay, and Paraguay, has been on hold since the conclusion of negotiations in 2019. And the two trading blocs have been negotiating the agreement for more than 2 decades. While the newly elected administration in Argentina has signaled support for the EU-Mercosur trade deal, this delay means that negotiations will be going into their 25th year. A successful deal would be a signal from Brussels that it takes Latin America seriously. So this isn't just about trade. It is an opportunity for the EU to redefine its relationship with 4 Latin American countries, and that would be at a time when geopolitical tensions have been rising. The EU is Mercosur's second biggest trade partner in goods after China, and the Mercosur region accounted for 16.2% of the EU's total trade volume in 2021. Removing barriers would enable more trade between the EU and the 4 Mercosur countries.
Chiponda, before I let you go, what would this deal mean for EU businesses?
Well, that, of course, depends on the businesses that you're asking. France has been against the deal because of its agricultural sectors. French farmers fear competition from cheaper agricultural products, and that's why we've seen the French government calling for stricter environmental standards. But here in Germany, the deal would be music to the ears of the country's manufacturing sector. Germany is an export-dependent country, and a trade deal would open up a whole new market for manufacturers here. Right now, only 2.4% of German exports go to Mercosur countries. So there's quite a lot of catching up left to do between Europe's largest economy and Latin America's biggest market. Supporters of the deal say, of course, that the EU needs a trade deal with reliable partners as well after Russia's invasion of Ukraine last year. And they also say that the bloc needs to reduce its reliance on China for raw materials. If signed, the agreement would be the EU's biggest yet, and it would also remove 4 billion euros of import tariffs on its products.
Well, we'll have to keep an eye out on how that deal progresses. Let's leave it there. Thanks for that update. That was Chiponda Chimbelu from Deutsche Welle.